Video 2, Nathan from Queens, Ultimate Traders on Reddit. It's been a while. I haven't been trading too much. I'm going to go over that in video 3. I actually completely changed my strategy. I'm going to go over that in video 3. I'm actually going to touch upon it right now because the state of the market, it's actually gotten a little bit worse. It's actually gotten a little worse. The reason why it's gotten a little worse is inflation has cooled, but it was dropping quicker. The inflation was dropping quicker 3, 4, 5 months ago. Now we're getting drops of 0.1, 0.2%. So inflation is slowly dropping, but it's very, very gradual. And the Fed went from 0.75 hikes to 0.5 hikes and 0.25 hikes. The last hike was a 0.25. And unfortunately, I do believe that the Fed should probably go back to 0.5. But if they want to do a 0.25, that's fine. So far in the year 2023, we've gotten one hike of a 0.25. Before the year started, I thought we were going to get 3.25 hikes. So we're now at 4.7. And we got one. We are going to get maybe even 3 more 0.25 hikes. So that means we're going to get a full 1% increase from December, where we're at 4.4. So inflation is going down very slow. Rates are going higher. And we just had earnings, and we're not done with earnings. Well, we're having the worst earnings season since 2018. Now, since November, when we had a CPI of 7.7 instead of 7.9 in November, the market has gone up in November, has not gone down. I've confirmed, and you could check on Google, that retail is more in the market now than ever before. So retail traders are close to 25% of the market. So that means 1 in 4 traders daily is retail. And when the market is really hot, retail is counting for 40% of trading volume. Why that's important is because it gives you an idea of the market breadth. The market breadth is horrible right now. So when companies have bad news, like Netflix had bad news, Meta had bad news, Roblox had bad news, give me a break. Roblox had growth of 2% from 569 million to about 580 million. They increased losses by 100%. From about $140 million in losses to $280 million. How are you going to tell me the stock was up 26% on atrocious earnings? Not bad, atrocious. Netflix losses, not their losses, their earnings decreased by 90%. Sales increased, I think, 5%. Same thing with Meta. I think Meta had a super decline in earnings and a less than 5% growth. So earnings is horrible. Inflation is super high. Rates are going high. And on top of that, since January 1st, the S&P and the NASDAQ have been up 10 or 15%. So you cannot go up through the roof on bad news and expect that we're not going to have any rug pulls. And the biggest problem is, and January 1st of 2022, most consensus analysts had S&P 500 earning $250 for 2022. And January 1st of 2020, Nathan from Queens had S&P 500 earning 220. Believe it or not, I did lower it to about 214, 215 from 220, but we're about to come in at either 220 or less than 220 for the full year. Now we're looking at 2023, and everyone has it wrong. Nathan from Queens has it right now at 208 for S&P 500, which means we're going to have roughly 3 to 5% decline in earnings. We're more than likely going to have flat to 5% growth in sales year over year for S&P 500 stocks. So guess what? If we have 208 on S&P 500 earnings for 2023, right? 208. So, take your calculator. This is the new Samsung S23. So take 208. And if we're going to have the decline in sales, decline in earnings, I can't give the S&P 500 a 17, 18 times earning. I might give it a 16 or 17. So if you give it a 17, we're looking at 3,500. We're looking at 3,500 on the S&P 500. If you give 208 times 16, you're looking at 3,300. And so sales is coming down. Unemployment is at a historic low of 3.4. GDP is around 3%. CPI is 6 point, what did it come at? 6.3? Yeah, 6.3, which means that there's a lot, and the JOLTS, which is job openings, is very, very high. Employment is strong, which means the Fed has ammo to keep raising rates, and GDP is still positive. The only number out of whack is inflation. The only way to get inflation down is raising rates. So if you're going to have more rate hikes and unemployment is going to go up because of rate hikes, right? Unemployment is going to go up. GDP is going to go down. Companies' earnings are going to go down. You might want to give S&P 15 or 16 times. Historically, so in a recession, the S&P 500 trades at 12 to 13 times. So let's just say it's 13 times 208. 208 times 13, we're at 2,700. Now, I don't feel like the S&P is going to hit 2,700 yet. But right now, my fair value on the S&P 500 is about 3,300. That's because I'm looking at S&P 500 earning 208, and I'm doing roughly about 16 times earnings. Because right now we're trading at 19, 20. Actually, what we're at? Let's say we're about 4,050. But I have earnings at 208. Everyone else has it wrong. Yeah, so we're trading at 19 and a half times earnings. We're trading right now at 19 and a half times earnings. But we are going to have a flat to 5% growth in sales and a decline in earnings. And for that, you can't give it a higher P ratio. So the state of the market is worse now than it was a couple of months ago. It's going to get better. It is going to get better, but it's going to take time. So I'm looking for inflation to come down, rates to complete, and I'm hoping to see a turn in earnings. Right now, earnings is not the worst yet. We might have one more bad quarter.